Vice Chairman Stanley Fischer, I've known for many, many years. I think maybe 45 or something like that. It's embarrassing. And I think of Stanley as a brilliantly serious economist and policymaker. In the early days, when he was just an economist, we had lots of interactions. And I remember one event, it was a time where we were trying to get engineers and economists to work together. We had a series of meetings to find, it's actually the concept was, oh, if engineers know how to get us on the moon, they can help economists control the economy. It was a little weird. But Stan was, again, brilliantly serious, but one time he just brought the house down because he said, you know, we've had these meetings about sharing ideas, and I've decided the economists have learned something fundamental from the engineers, and that's how to use an overhead projector. And believe it or not, before that, we were using blackboards and chalk, and the overhead projector was the big innovation, but it was terrific. But of course, other than academics, Stan has been chief economist of the World Bank, first deputy managing director of the IMF, governor of the Bank of Israel, now vice chairman of the Federal Reserve, and a little private sector in between. So it's a real pleasure to have you. Thank you for coming, and we look forward to your remarks.
Thanks very much, John. It's a pleasure to be at the Hoover Institution again. You know, we throw big numbers around these days. It's 36 years since I spent a year here, and enjoyed it very much. And not only was it a pleasure being here because it brings back memories of the days I could run up to the dish, and many of the people here, but really many, are people with whom I've discussed monetary policy over the years, and and from whom I've learned a great deal. And I'd also like to congratulate John on many things. I remember when I commented on one of his papers at Brookings, telling the tale of I think he was 75 years old. We had a carpenter who was installing bookshelves in our house. And an old man, they told me he was very, well, I used to think it was old. He told me, people had told me he's really good at it, and you'd see this old guy show up in his truck, and the library, the place he was putting the bookshelves was up about 7 or 8 steps. He put this huge bookshelf on his back, climb up the stairs without any signs of effort, put the bookshelf in place, take a hammer, sort of tap it a few times, and the thing was there forever. And I said, watching John Taylor work is similar to that. Here's a guy who makes it look very simple, does it very, very neatly, doesn't show any signs of effort, and my God, it works. And there it is. So it's a pleasure to be with you again, John, although I miss you as I go running down the Potomac in Washington.
Yeah.
I'm going to talk today about I'm going to make some observations on monetary policy rules, observations you've heard many times from people in the Fed, and then talk about committees. So I have 2 messages. First, policymakers should consult the prescriptions of policy rules, but almost needless to say, they should avoid applying them mechanically. And I often think of rules as being a question of how much attention are you going to pay to them. You're sure you're going to pay attention to them? Are you going to go to the extent of being bound by them? And if so, for how long, and so forth. And rather than saying rules are good, implying you have to implement them, or bad, implying you don't, they're very good, very useful, and the question is just how much weight do they receive in your decisions? And second, policy-making committees have strengths that policy rules lack. In particular, they are a way of adjusting to new information and of aggregating a wide variety of a wide variety of information, and let me add a word, a wide variety of perspectives. You look around this room, there are a lot of perspectives on monetary policy, on rules, and what exactly monetary policy should be doing on a given day. And it's no accident that the Fed was set up with the type of committee it has, because the arguments in setting up the Fed related to what is going to be the influence of the bankers, i.e. New York, versus what is going to be the influence of the people who actually do the work, i.e. the rest of the country. And it was a tremendous argument. And if Woodrow Wilson hadn't been a newly elected president, it wouldn't have happened in a newly elected president with a lot of power in the Congress. It wouldn't have happened then, but it did. So let me start. I've considered monetary policy rules since May 2014 as a member of the FOMC, but my interest in them began many years ago and was actually among the earliest work and publications, work that I'd done and publications that I've had. At that time, the literature on monetary policy rules, especially in the United States, remained predominantly concerned with the money stock, or total bank reserves, rather than the short-term interest rate. Seen with the benefit of hindsight, that emphasis, that is on money rather than interest rates, probably derived from three sources. First, the quantity theory of money. If you're going to talk about inflation, well, the things we were told in our first class in economics, namely excess money growth causes inflation, made you think about discussing rules for money. Second, that research, early 70s, was carried out when monetarism was gaining increasing credibility in the profession. And third, there was a concern that interest rate rules might lead to price level indeterminacy, which is an issue that has since been disposed of by Bennett McCallum and others, although I heard it being discussed yesterday, I think, by John Cochran. So it's still around, if not the main view. Subsequently, John Taylor's research, especially his famous 1993 paper, was a catalyst in changing the focus toward rules for the short-term interest rate. And his work thus helped shift the discussion in favor of rules for the instrument that central banks actually prefer to use. There's a footnote in this paper which says that when I was working together with Philip Cooper on monetary rules in the early 70s, it was true that when we presented that at a seminar where Franco Modigliani and Albert Ando were present, that they said, that's ridiculous. You have to look at interest rate rules. Money rules are not of any great interest. And I sort of listened and carried on doing stuff on money rules. John's 1993 study also did something very important. It highlighted the practical relevance of monetary policy rules, as he showed that a particular simple rule, the one that now bears his name, provided a good approximation to the behavior of the federal funds rate during the early Greenspan years. And the research literature on monetary policy rules has experienced a major revival since John's seminal paper, and it, of course, concentrates now on rules for the short-term interest rate. Consideration of interest rate rules has also come to have a prominent role in FOMC discussions, with the Taylor rule being one benchmark that we regularly consult. Now, I should make clear, John, that you face a conflict here. We think we discuss 5 or 6 Taylor rules at each meeting, but I've been told that you want the Taylor rule to be only the 1993 rule. So you have to decide on quantity versus quality and let us know what you think. So we say Taylor dates and so forth, but they're all derived from the same general approach. They're not exactly what you said, although one of them, Taylor 1999, is exactly what you at least have written. But I'm going to build on recent remarks I've made elsewhere. I'll also indicate why policymakers might have good reasons for deviating from these rule benchmarks and why that could be appropriate. In particular, I point to reasons why the FOMC's discussions might lead to decisions that depart temporarily or permanently from the from the prescriptions of a baseline monetary policy rule. Now, some perspective on how policy rules are discussed in the FOMC is provided by considering what has changed over the past 20 years. Donald Cohn, at a landmark conference organized by John Taylor almost 30 years ago in January 1998, described the role played by monetary rules in the FOMC briefing process. His account noted that Federal Reserve staff members present FOMC participants with prescriptions from several policy rules, including the Taylor 1993 rule, and that remains true today. And if you didn't believe it then, the blue books and teal books, the books that the staff makes available to the FOMC participants before each meeting, demonstrate that the coverage of policy rules in the briefing material provided by the board staff expanded considerably in the years after 1998. Oh, it's 1998. I said 1988. Sorry. So it's only nearly 20 years ago. You can find those teal books on the the FOMC website, on the Fed website, and they're there up to 2011 because there's a 5-year lag in making our the transcripts of our work public. Don Cohn noted that policy rule prescriptions serve two functions: as a benchmark for the stance of policy. How does this compare with the Taylor rule or other rules? And second, to structure thinking about the implications of incoming information for the direction of policy action. These two functions continue to be important. Policy rule prescriptions provide a useful starting point for FOMC deliberations and a convenient way of organizing alternative arguments about the appropriate policy decision. Policy rule prescriptions, particularly those obtained from a dynamics model simulation, also help policymakers take to heart a key message of the literature on policy rules, namely that monetary policy decisions should concern the appropriate path for the policy instrument and not merely the current setting of that instrument. And of course, if you read the transcripts of FOMC discussions, you will see that much of the discussion is frequently about the future, about the path for the policy instrument. Cohn also observed, quote, that in truth only a few members look at this or similar information regularly, and the number does not seem to be growing. That state of affairs has probably changed in the 2 decades since Don wrote, and it's clear from the transcripts that rule prescriptions have frequently been cited and frequently are cited at FOMC meetings. And the prominence that interest rate rules have achieved in Federal Reserve policymakers' analysis of monetary policy was underscored by Janet Yellen in her speech at Stanford earlier this year. Further, as is clear from John's econometric derivation of his 1993 rule, actual policy decisions may and probably should exhibit systematic patterns that can be described as a rule. And in fact, as mentioned already, one attraction of John's rule was that it seemed to describe U.S. monetary policy decisions well over a certain period, and one that was associated with a reasonable degree of economic stability, one which many people began to think was bound to continue, but which, alas, has not continued. Nevertheless, central bankers who are aware of the merits of the argument for policy rules have on occasion deviated substantially from the prescriptions of standard policy rules. And further, while the implications of different monetary rules are described in the Teal book and typically referred to in presentations by several FOMC participants, the overall discussion in FOMC meetings is not generally cast in terms of how it relates to one version or another of the Taylor or any other rule. Another set of rules is mentioned frequently in FOMC discussions, and they are Vixelian, for it is often a discussion of R star, which in some formulations of the Taylor rule is also the constant term in John's rule. I have at this point to mention what the discussion is really about, and this concerns a conversation with one of our sons. The conversation is essentially about, are we going to leave the interest rate where it is? Are we going to raise it, or are we going to lower it? Well, there's a lot of discussion, but that's the subject. So once my son called me, had some problem relating to something in economics, and I said to him, he called on a Monday night, I said to him, I was preparing for the FOMC meeting, can I call you on Wednesday? He said, Dad, I don't understand. You've been at the Fed 2 years. The interest rate hasn't changed by a basis point. What is it that you do there? As far as I can understand, you have three choices. You can raise the interest rate, leave it as it is, or reduce it. I said, that must take you 5 minutes. What do you do in the rest of the time? He kind of reminded me of an aunt of mine. I'm sure you all had aunts like this who would ask you, what do you do as a professor? And you'd explain that sometimes you teach classes and so forth. And what about the rest of the time? Well, I had a feeling a bit like that. Anyway, the period since 2008 bears testimony to central bankers' willingness to depart from the prescriptions of a pre-specified rule. In the wake of the financial crisis, policymakers found it necessary to follow a more accommodative monetary policy that they judged was appropriate for the new economic conditions. And in addition, and this is probably a change that will last a while, structural changes in the US economy appear to have lowered the value of the interest rate of R star, consistent with a neutral policy. Now, if things happen that change the values of parameters, then you could expect that policymakers might just simply change the rule, and they might develop a procedure for revising the monetary rule. But a rule that is frequently revised doesn't really qualify as a rule in the sense that we currently use the term. When we're considering the relationship between monetary policy decisions and monetary policy rules, we can expect two regularities to hold. First, actual monetary policy will sometimes appropriately depart from the prescriptions of benchmark rules, even when those benchmarks describe past decisions well. And second, in their use of rules, policymakers will from time to time change their assessment of what rule they regard as the appropriate benchmark. Both regulations have been amply observed in recent years, but they were also present 20 years ago, as reflected in Cohn's remark that policymakers, quote, do not see their past actions as a very firm guide to current or future policy. Or as a teacher of mine at the London School of Economics, Richard Sayers, put it much earlier. This is an interesting article that he wrote. There's a reference to it the references in the version of this paper that's on the Fed website. There is no code of eternal rules. We have central banks for the very reason there are no such rules. Namely, as everyone knows, if there was a rule that would hold forever, you would not need very large central banks, except if they were the bank regulator. That I think is true. But there's another factor, and that relates to the fact that monetary policy is made in most economies by committees. And At this point, I think I should mention the insightful paper by Kevin Walsh, which bears a 2016 date, but is actually at the 2015 conference, I think, and the discussion of it by Peter Fischer and others, including George Schultz, who I'm very, very delighted to see present at this event, that discusses aspects of committee decision-making that are likely to affect the quality of decisions reached by committees. And that was a paper that focused on the Fed and the Bank of England. And I would say that the comparisons were not entirely favorable in favor of the Fed's procedures, some of which stem from the fact that there are 19 people when the board is full sitting around the table, each of them with the right to say something, and at least 12 of them with their independent board of directors of their bank, which expects their guy to say something. So they're only doing what the board asks them to do. They're naturally not guys who want to talk, but they're forced into it. The fact that we're talking about that decisions are made in committees is not an incidental feature, and it affects many, many things. And I read in reading the discussion of Kevin Walsh's paper, I think it was John Cochran who said how great the procedures are of appointing people at the University of Chicago. Well, when I was in the University of Chicago, they allowed the untenured assistant professors to take part in the meetings on tenure for other people. I thought that was pretty strange. And the strangeness was revealed when somebody opened his mouth and told the truth, an untenured guy. He said, look, I know if you appoint that guy, I'm not going to get tenure. How do you expect me to vote? And so I don't think the procedures at the University of Chicago were that terrific, Kevin. Anyway, policy rule prescriptions are more consistent with a single perspective on the economy than with the pooling of multiple perspectives that is associated with the committee policy-making process. And many of you must have read Roger Lowenstein's book, America's Bank, which describes how the founding of the Fed involved reconciling a large number of interests in the United States. And in similar vein, the modern FOMC framework, the modern framework dates from 1935, involves participation by 12 Reserve Bank presidents, each of whom represents a different district of the country. And the FOMC framework is also designed to balance the role of Washington and the role of the rest of the country, with Washington having 7 voting members when there are 7 members of the board. There are now 4, and the presidents having 5 voting members. Now, in principle, they all have a common goal: maximum employment and price stability, and those are given by our statutory mandate. And they've also agreed on a statement on longer-run goals and monetary policy strategy that describes, not in huge detail, but enough, what that statement means. But people bring different perspectives or views of the world to the meeting. Part of their role is to articulate that perspective and perhaps persuade their colleagues to revise their own perspectives, or vice versa. A member of a committee may well have important economic information not known by their colleagues until he or she relays it. This point is brought back to me each time I sit at an FOMC meeting and the presidents start with a description of what's happening in their district. And it's actually very interesting. And I have this terrible weakness. I sort of vaguely remember data, but I remember stories much better. And when somebody describes an event or something which gives you a sense of what's happening in their district, it makes more of an impression on me than another number relative to things, and I think that you do, at least I personally, do get a different perspective from different regions that I am forced to try and integrate into my head and integrate its relationship with whatever rule or whatever decision, whatever rule we use or whatever decision we're about to make. That means that the information underlying a policy decision is crucially shaped by a committee system. Committees can aggregate a large volume of diverse information about current and expected future economic conditions. And that, as I've just said, implies anecdotes and impressions gleaned from business and other contexts, which can provide insights that are not recorded in current data releases. We, of course, have the beige books, but it's not the same as hearing it come out of somebody's mouth and being able to say something to them and ask questions about that. I think this will leave the FOMC less inclined to follow a benchmark rule. For example, the committee's discussions might point to factors that have not yet affected real economic activity and inflation. And this couldn't statistically change a rule like the Taylor rule, because the prescription that the committee comes up with is probably more a function of current values of the impression that people have about the output gap and future output gaps, and similarly for inflation. Now you can say, well, of course, if there's serial correlation, any rule that includes recent events is going to have serial correlation in it and will be taking account of the future. But you may have special information about the future which you would want to incorporate in your decision with respect to what's going to happen in coming months. And policymakers may also encounter unexpected or unusual events, or both, or they might perceive changes in the structure of the economy. A committee process is conducive to assessing the appropriate policy response to these developments. And a case in point is the decline in estimates of the neutral interest rate of R*. R* is a way of summarizing various forces, many of them unobservable, that shift the relationship between monetary policy and economic activity. Bringing diverse perspectives to the table is a pragmatic way of confronting such very deep sources of uncertainty, and they're very deep. There are things that are going on in a massive economy in many ways, in many different industries, and you've got to get them down to one number. And a committee discussion can flesh out the factors behind changes in the neutral rate, and a committee would likely be able to identify such changes more promptly than would a straightforward statistical exercise because of the wider set of information from around the country that the committee is able to process. Now, this decision-making environment means more flexibility for FOMC members than they would have if they simply followed a policy rule. Well, there's not entire flexibility because transparency and accountability must figure heavily in any more flexible environment. The FOMC's policy communications include its post-meeting statement, the minutes of its meetings, the chair's quarterly press conference, the chair's semi-annual monetary policy testimony to the Congress, and public remarks by individual FOMC members. And in this framework, policymakers articulate the reasoning behind each decision and in particular explain how the policy decision contributes to the achievement of the committee's statutory mandate. If I can insert a footnote, people complain about the cacophony that we get from having all the presidents speak. Well, there is a cacophony, but guess what? The cacophony represents views that are expressed in the board as well, and we've got to make something out of that cacophony and make a single decision. It's not that people can possibly, if you have a committee, people are unlikely, very unlikely, to walk around having the same view. It doesn't happen very much. And so, yeah, there's a cacophony and it's irritating, and this one thinks that and that one thinks this, but that's what they're there for, to say what they think and to describe why they think what they think. So I would find life much easier if there wasn't a cacophony, but there it is, and we've got to deal with it. Now, there's a deeper question about committee decision-making. Why have almost all countries decided that monetary policy decisions should be made by a committee rather than a rule? Well, there's a simple answer. Laws in most countries are passed by institutions in which committee deliberation is the norm, e.g. the Congress. But if that's the answer, then we have to ask why that has become a norm in almost all democracies for almost all collective decisions. And that is the way democracies have devolved, have resolved the divergences of view on important issues that serious people have, is by setting up committees and requiring committees to make decisions on particular dates or on particular issues. Because opinions differ among experts, democracies tend to prefer committees, which involve experts and in many cases other representatives of the public who discuss, try to persuade each other, and must at the end of their deliberations reach a decision. But, going back to the emphasis on transparency, those decisions have to be explained to the public and to other parts of the government, and hence the appropriate emphasis on transparency and accountability. That's the democratic way of making decisions when opinions differ, as they often do in the monetary field. And if you don't think they differ, look around this room and you'll realize that those differences have to be resolved when the committee makes a decision. I've been a governor of 2 central banks, and even as the sole monetary policy decision maker in the Bank of Israel, would sometimes find that my initial view on the next decision changed as a result of discussions with the informal advisory committee with whom I consulted at that time. Those discussions, which recognized human frailty in analyzing a situation and the need to act despite considerable uncertainties, are the reason why committee decision-making is, on average, and I emphasize on average, preferable to the use of a rule. Emphasis on a single rule as the basis for monetary policy implies that the truth has been found. It's very rare that the truth on issues like this is found. And in this case, that truth would have to transcend the record over time of major shifts in monetary policy, from the gold standard to the Bretton Woods fixed but changeable exchange rate rule, to Keynesian approaches, to monetary targeting, to the modern frameworks of inflation targeting, and the dual mandate of the Fed, and more. We should not make our monetary decisions, policy decisions, based on that assumption. Rather, we need our policymakers to be continually on the lookout for structural changes in the economy and for disturbances to the economy that come from hitherto unexpected sources. My view of decision-making when I was governor of the Bank of Israel was somewhere out there's some damn disturbance that is going to ruin the current plan, and it's my job to figure out what it is, our job to figure out what it is, and it's probably coming from the back of from behind me, not from there. And sometimes that was true, and often it isn't. But that's, I think, the right attitude to how we should think about policy and be ready to change what we want to do, what we think we should do. So let me sum up. The prescriptions of monetary policy rules play a prominent role in the FOMC's monetary policy deliberations. And I think our discussion would be different if we made the question, how much weight should be given to a particular policy rule in making your decision, rather than is it right or is it wrong? They're all going to be useful, almost all going to be useful. They're all going to be informative. You need to think about them. Should you implement them exactly? I think that will be rare. But in view of the usefulness of rules as a starting point for policy discussions, and the fact that comparison with a benchmark rule provides a useful means of articulating one's own preferred policy action, you have to look at the rules. But, and I'm summarizing now, adherence to a simple policy rule is not the most appropriate means of achieving macroeconomic goals. And there are very good reasons why monetary policy decisions are typically made in committees, whose structures allow them to assess the varying conditions of different regions and economic sectors, as well as to reflect different beliefs about the working of monetary policy. Thank you.
So, thank you very much, Stan. It's actually hit on one of the most important issues I can think of is how you have strategies or rules where committees are making decisions. And there's lots of questions, but I just want to just raise a quick one. Greenspan, when he was chair, said the Fed deserved an assist in creating the Taylor rule. And so there was a sense in which there are periods where there's more or less adherence to I'll use the word strategy. And so it's not impossible to think about committees coming to agreement on a strategy, even in a democracy. There are laws are passed. I'm not saying this should be a law one way or the other, but a law is a way to come to an agreement, and some people disagree, but there's compromises. So it's not impossible, and it sort of has some history. I'm not saying I agree 100%. You focused on a very key, important issue here, but it seems to me it's not impossible to put committee-making decision and rules-based policy together.
Well, I think that's right. It's not impossible and can be done for a period of years. They always break down, and then you have to figure out what set of rules you're going to have for changing the rules. You know, in Canada they have inflation targeting, but every 5 years the central bank and the finance minister have to reach a fresh agreement on it. That's a way of dealing with the uncertainties. That's not impossible to envisage. But I think that we've gotten ourselves. Well, I'm always struck by one thing, John, and you'll excuse me explaining this to the crowd. When John and I have a conversation on monetary rules, I come out thinking, why the hell do we think, why do people argue about this issue? But then people do argue about this issue, and I think we've got to ask ourselves, what is the problem? And I think the problem is we're describing a rule as something which is a rule of the Medes and the Persians. It's never going to change. And we know it's going to change. And that, I think, is the emphasis that we haven't sort of placed on anything. So I can envisage, say, in the case of inflation targeting, a procedure in which you change the target or you change the other variables that are involved on some regular basis through some regular participation and as a regular calculation, a regularly undertaken calculation, and you say that's my rule. My rule is an equation at a moment of time combined with footnotes which tell you how to deal with special circumstances, and combined with another few paragraphs which tell you how to revise it over the course of time. That seems to me, if that's a rule, that sounds like a law. It's something that I could envisage.
Yeah. Okay, it's Bob Heller.
Thank you. I'm Bob Heller. Stan, you talked very eloquently about the advantages of the diversity of views that you get in the FOMC in the various opinions, and that really helps. Why do you think there's that enormous pressure of people to have unanimity in the FOMC? Why not have, like the Supreme Court does, you know, decisions 7-5 or 6 to whatever? So that would actually reflect the diversity that you so value?
I think the issue relates to the size of the committee and the need to drive it to a decision on a particular date. I mean, Mervyn King used to say that he wanted to be in the minority from time to time just to show that he could be in the minority and that the world didn't end that day, nor did the Bank of England break down on that particular day. Well, that's not been the tradition in the Fed. The tradition in the Fed goes the other way. And if you have a fair number of divergences of view, of dissents, you already start being in trouble as people who think very highly of Paul Volcker, but also know that in the end he had difficulty getting his decisions, some of his decisions through. The system could sort of tend to break down. What happens if there isn't somebody trying, or some group trying to drive decisions in a particular direction over the course of time? And many of the things, if you had a close mind, if you had a very close to having two political parties in the 19 members of the board, I think you'd have a very bad monetary policy. And it's that need for some coherence to what comes out that pushes the Fed in the direction of preferring having few dissents. I mean, in preparing for this lecture, I read some of the stuff, a lot of it in papers and books, edited by or written by John Taylor. But the literature on what size committee is optimal says 5. I was chair of a committee of 6, which had originally been 7, and just to tell you about Israel, I thought, well, it'd be fine, so we'll have 4 outsiders and 3 insiders. So we put that in the law, and I sent it to the Treasury, and the head of the Treasury called me and said, listen, Stan, you're not in New Zealand. You're in Israel. If you don't start with some advantage, you're going to be outvoted very, very often. So we got down to 6 with a double vote for the chairman if there was a tie. So we had a small committee, but there was that characteristic. And then something very interesting happened, which relates to the Fed in some way. I never used the double vote, but somewhere near the end of my term, as the meeting progressed, I saw I was about to have to use the double vote for the first time. And then we had the vote, and whatever my view was, won 4-2. So after the meeting, I spoke to the guy who I had known for sure preferred the opposite decision, and said to him, why didn't you vote as I expected you to vote? He said, I thought this issue was too small for you to have to break the rule of not using the double vote. So that's when you see a committee trying to work as a committee and not as 6 different people. Now, there are questions about that. The principles set out for the Bank of England are everybody votes as a person and not as a member of a committee. And, I'm not sure what is better, because you've got to keep meeting, you've got to keep making decisions, and you've got to be able to speak freely if you're going to make good decisions. I don't know which way is the right way. On that particular day, I appreciated that guy's choice, but it wasn't critical in any way. It was just something about forming a group of people who make a decision.
George Schultz has a question.
You have a broad mandate, and you have certain specified tools. But it must be sometimes you see that the tools you have aren't enough to satisfy the mandate. Maybe you think tax policy should be different or spending policy should be different. To what degree do you feel a compulsion to speak up on behalf of your mandate to get other people to do what they should do?
Well, to answer your question, the answer is, at first thought, very often I'm tempted. And then I say to people around me, I'm going to go and say something this time. And they will say, you can't do that. And then I say, why not? And they explain to me why I can't do that. The last thing we need is a war with the Congress, for example. So in the end, I barely express my views. That was not the case in Israel, but it's a different culture. On the first day I was there, I said to a fairly large staff, what I don't want to hear from you is what you think my views are. And I really, if I find examples of that, I'll be very irritated. Well, I didn't suffer from that problem at all. They don't, they don't care. They just say what's on their mind, and that's a very attractive way that, to my mind, the society works. But it may only work in a small country, and I'm not sure it works in a very large country. Mike? Oh, sorry, you're in charge, John.
Stanley, my question is a corollary of George's. To what extent do, and to what extent should, the FOMC be taking into account the effect of their behavior on enabling fiscal policy that might be deleterious long term? For example, enabling greater government debt issuance, long-term debt issuance, especially when the deleterious effects may be well outside what you're kind of looking at in the short-term determination of monetary policy.
Yeah, Mike, I've thought about that often in having arguments with the European non-central bank officials about what they want the ECB to do. And I've decided I'm not going to play that game. I'm not going to be somebody who undertakes a policy that is not in my area, to influence something that is not in my area, that is the clearly defined responsibility of someone else, the finance minister or the government, as the case may be, because I will inevitably have to start lying at some stage if I'm going down that route. Why do you say this, Mr. Fischer? And then you'll start giving some story which is not exactly the true story. So I've decided that I told European policymakers, you're asking me to do your job. You're the finance minister. These are people who just talk to me, people I know. They're not people I've formally advised. You're the finance minister. You want a small budget. You want to have a small deficit. Well, go out and argue for it. I'm not going to go out and argue for it on your behalf through my actions. Well, it's a very tough point to get to, but I think that having to go out and play the other game is not one which which you'll be capable of doing for any length of time. I am sure that, Mike, that on some day there will be, and George, there will be things on which you say to yourself, damn it, I just have to say something. But the bar is very high and should be very, very high. It's not our job.
So Andy Levin has a question. We got to wrap up soon.
So I really like Peter Fischer's proposal. I'm just curious if you would react to it. He's argued several times, including at this meeting a couple of years ago, that the central bank at its organizational meeting every January should adopt a quantitative strategy, a benchmark, a rule, if you like. It would indicate clearly to the public that it's going to follow that benchmark through the year. It explained to the Parliament or the Congress why it's adopted it, how it's relevant for the future and the past. It could be a Taylor rule or a variant of the Taylor rule or something else, but a quantitative strategy. It would solve the cacophony problem to a very large extent. It would be flexible because it could change it in future years, or if it works well, it could stick with it. So it seems so sensible to me, in which, of course, I think of Peter Fischer being very sensible. Why isn't that the right way forward?
Because I don't understand the logic of it. What is it? You can fix it for a year and change it. And in the middle of that, something happens that indicates that you left something out of your rule. That's what happens. You get into a crisis, you have to do something, and you do it. And you do things that are in your power. We don't have the capacity that the English have, the British have. They're still separate groups at the moment. That the British have, which is the central bank, the governor of the Bank of England can make a deal with the finance minister, with the chancellor of the exchequer, that will stick. I think a deal between the chairman of the Fed and the secretary of Treasury on something that is important will not stick. So we don't have such an easy capacity of flexibility with regard to the law, and that is a problem. But Andy, I don't see what is the benefit of that. We're telling people in the market, look, guys, we're just a terrible source of noise. When we take actions normally, we take actions that may not be intended to help the economy. If you want to know what we're going to do, decide what people like us do on the basis of our record, and put your money where your mouth is. And I frequently think, and this is impolitic of me, to think that way. What is the job of people who make their living off the market, of the financial markets? It's to make a living off the financial markets and to thereby, if you believe in some invisible hand, and to thereby cause the markets to move in a direction that supports, or in cases where you're screwing up, makes more difficult the job of the central bank. So they've got to do something. And I can't figure out, aside from making their lives easier, what we're doing. That's a question, Andy.
So I think that what the Fed has said many times is data dependent, not calendar dependent, and that's what a benchmark is. That's the whole point of the quantitative strategy, is to explain how and even contingency planning how things would change if something happens during the year.
So we have, let me just interrupt. One last question from Mike Borda.
Stan, my question is, why was Greenspan so successful in following what maybe, ex post at least rule-like policy? Was it good luck, or was it good policy? This is an old question, and the reason that people often give for what happened since is, well, we had a big crisis. And so my question is this crisis a climacteric? Is it a real change in the world, or are we going to go back to something like a normality? And my reading of American history is we're going to go back. And if we're going to go back, then why can't we have a kind of rules-based system?
But what is the benefit of the rules-based system if you appoint decent people to the job and they say this is what we plan on doing, but they don't follow a rule that is publicly announced? What is the benefit of that? I'm going to stick to this. I know there'll be occasions when it's wrong. Why do I have to say that? Yeah, but the question is, am I committed to this thing or not? Are there occasions on which I will be doing things which I otherwise wouldn't do if I didn't have the rule?
You do it for 6 weeks at a time. You see, for the next 6 weeks, we have Fed funds rate.
That's true. I mean, the Bank of India has, I think, only 4 scheduled meetings a year. But they're allowed to change the rate in between meetings, and apparently they meet every week to change. So I'm not sure that's what we do, but I think
rules are contingent. You've said this before. It's the contingencies that matter.
I think we have to stop. I agree we shouldn't have meetings every week. But Stan, thank you so much.